Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You've heard of eagle investors, the ones always hunting for the next big multi-bagger, the next hot sector, the next 10x stock. But here's the truth that shocked me. Most truly successful investors are not eagles. They are squirrels. Yes, squirrels. Cautious, risk averse, survival minded. And today I am going to prove it using Prashant Jain's own numbers, Warren Buffett's track record, and a 10-year study I ran on 220 stocks across 11 PE or valuation multiple buckets. Let's go. So Prashant Jain, legendary former CIO of HDFC Mutual Fund, managed Indian markets for nearly 2 decades. In his final letter, he revealed something extraordinary. Over his tenure, he held 465 different stocks across his portfolios, but just 55 of them, barely 12%, contributed 85% of all his gains. Think about that. The other 410 stocks, they were laggards, break-evens, or outright losers. Now move to Omaha. Warren Buffett and Charlie Munger have said the same thing. If you remove just 10 to 15 of Berkshire's best bets across 60 plus years, the record becomes average. Charlie Munger put it bluntly, it's remarkable how much long-term advantage we have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So if even Jain and Buffett didn't know which stocks would win, what were they actually doing? Well, most people think great investors are eagles. Eagles soar high, scan wide hunting grounds, chase new challenges, and live for growth. But Prashant Jain and Warren Buffett? Well, I call them squirrel investors. Squirrels are cautious. They prioritize safety. They avoid predators. They survive first, thrive second. Here's the key. Squirrel investors don't try to predict winners. Instead, they focus on avoiding the zeros. Why? Because a long stream of numbers multiplied by 0 ends in 0. One fraud, one bankruptcy, one permanent loss erases decades of compounding. So their mantra is simple. Tilt the risk reward in your favor, stay alive, and let the 55 winners find you. I wanted to test this squirrel hypothesis myself, so I ran a study. My goal, minimize downside, no qualitative analysis, no industry research, no trying to pick winners. I created 11 portfolios of 20 stocks each, rebalanced every 12 months from December 14 to December 2024. The only filters: minimum revenues of rupees 200 crores, positive earnings in each of the last 5 years, daily liquidity of greater than or equal to 10 lakhs or 1 million, and debt to equity between 0 and 1. Then I divided stocks into 11 buckets based purely on PE ratio and price to book value. Now look at the screen. Every number you see is what rupees 100 invested in that bucket grew to over 10 years. For example, the P3 bucket, PE between 10 to 15, grew to rupees 1100 from rupees 100. The P2 bucket, PE between 5 and 10, grew to rupees 1000 from rupees 100. The P1 bucket, the only bucket that was price to book value based, grew from 100 to rupees 864, and so on. For comparison, the BSE small cap index was up nearly 5x. The BSE 500 index was up a little over 3 times. The Sensex was up almost 3 times. The result: every single low to moderate PE bucket, that is P2, P3, P4 and even P1, crushed the benchmarks. P3 turned rupees 100 into over rupees 1000, nearly 4 times the Sensex return. But the high PE buckets, that is 40 times and 45 to 50 times, underperformed the BSE small cap index and were very close to the Sensex and BSE 500 returns. So what does this tell us? Well, you don't need to be an eagle. You don't need to pick winners. You just need a simple, repeatable framework that avoids overvalued traps and keeps your downside protected. The winners will emerge on their own. So here's the conclusion. Prashant Jain's 55 winning stocks out of 465. Buffett's 15 decisions out of a lifetime. My PE study showing low multiple portfolios turning rupees 100 into over rupees 1000 in 10 years. The common thread? These investors did not know which stocks would win, but they built systems where the winners, when they came, were large enough to carry the rest, and the losers were small enough not to blow everything up. So here's my question for you. Are you investing like an eagle, chasing highs, hunting new ground, hoping for a 10x? Or like a squirrel, careful, disciplined, focused on survival, knowing that the winners will take care of themselves? The data says the squirrels do end up with very good long-term returns after all. So if you found this useful, please like, subscribe and comment below. Are you a squirrel or an eagle? This brings me to the end of today's video. I'll see you again in the next session. Goodbye and happy investing.